The chart you're looking at is that of the silver price in US currency. I'm going to be looking at this on multiple different time frames as it is now enduring what looks like its third smackdown in 2011. Now the first one occurred earlier on, which thus established what I considered to be a guaranteed higher low because of the enormous run higher. We'll get more into that when we look at this on multiple time frames. But after it established the support level around the low mid-30s, then it found the new area, boom, smackdown 2. Question was, will this area band of support be an area band of resistance? And the answer most certainly turned out to be that of yes. So we're seeing what looks like the third wave lower. So what would be the band we would be looking for? And that would be really in the area of 29 to about 32 within that type of level. What I'm going to do is I'm just going to do a little bit of cutting and pasting, basically. We'll cut this down move, and we'll put this on another blank image. So we'll just stick it right there. And we'll do it again for the second wave lower, which would be something like this. We'll get the whole aftermath as well. So we can say goodbye to that smackdown period and put it right beside the previous one, and quite frankly, very similar to say the least. And now, if we were to be having another one, the most reasonable spot would be that still, I'd rather start at this high, we'll say. And there we have it, 3 moves lower. Obviously, the first 2 hit a lot more. And therefore, if we take the length of the pattern and move this on to the most previous spreadsheet, or the most previous image that we are looking at, then the type of move lower would be going from like 50 to 40, which is a loss of 20%. So a 20% down move to continue its previous rate of descent. And they all change anyway. This run up higher had a couple good, decent trend lines. This one, obviously, with a lower rate of ascent, as did the other two. And that's important to realize that when this was going on, the market was in a uptrend in every single time frame, pretty much. And then after down moves, the correctionary phases were still lower than the entire run higher. And the market closed the previous year at about, I'm trying to think offhand, $30 and change. I can get that exact in a moment, but it's going to be extremely hard and almost now guaranteed for it to be a down year. As far as the volatility is concerned, we were sliding into low volatility at the end of the year, and I was not surprised to see this really go down towards there. And I'd even like to say I'm not surprised that I'm seeing the higher volatility bring the market lower, since the markets, the way they are traded and priced, it's just no surprise. We've seen it a lot this year, and it's the central bankers that we know are maneuvering these things. And what else do we expect, as long as we allow them to do what they're doing? And if we allow it, then they're going to do it. That's the most simple analogy, to say the least. Now we're going to take a look at these markets on multiple time frames. This is the quarter date chart, and I can put in or crop in the moving averages and the automated Fibonacci within this. And basically what we have in here is nothing more than a major downtrend. And after it found this level at this significant support of Fibonacci, it held there for a while with the moving averages staying sideways and plump. And this Fibonacci was only known after the fact. However, when this market's going lower and you're trying to think, oh, where's it going to bottom? Then what you would like to do is take the high from the market and figure out on which low will it take for this Fibonacci line to match up with this level, and this level, which is really a range of about 29 all the way down to 28.50. That's where I would be expecting, as it's going lower, where it would find some sort of lower bottom. And if it continues to go lower, then where does this line match up with it here? Thus, if the market's top, maybe we hit this 18-period average of closes and continue to go lower, then whatever it takes for this line to go pretty much down to here, that's what I'd be looking for the spot where it should find an area where the market will change direction. Moving this on to the daily chart, and I think what's important to note here is the comparison with last September. That's when we originally came down to this period, which was 26.10. At least it should be. It looks like it's lower on here. Let me just quickly take a look in here, which, yeah, I got 26.10. Therefore, we came down very, very close to it today. But within this move, the move before brought us from 26, and in that period up to 30, and the next day to 33. That was a gain of like 20%, really, really quick. Well, the reason why was because the length of the move was that enormous that that's where the next high is going to be. Same here, same thing here. That the next move right now you would be thinking is this level of support right in here, which generally looks in the area of about 28.50 as an area where you would think you could encounter some level of resistance. This is the 3-day chart, each candle representing 3 days. And like I say, we're now back to this level where people like to call it a double bottom, and it's not. I basically call it back to previous support. Will we find support there? And if it does, then if we basically find resistance at this level I talk about in the low 30s and anywhere lower and come back lower, the odds do favor that you take it out. In fact, not only that, but we've already had a little small gap higher that if, say, the end of this week and the start of 2012, if the market continues to go lower, you would expect it to penetrate lower at a pretty decent speed, especially if it's after 3 days after the New Year's, as now it's time when the markets are usually pretty light. Moving on to the weekly chart within this type of formation in here, there we can see that level. Where's previous support? Roughly here around 18.5. And then by moving this to the, we'll go the 9-day next, each candle representing 9 different days. It's already got the bands in this already. And this is a significant thing here because I got a Fibonacci support level that hasn't been touched. It was pierced above within that September fall. And currently it's still a pierce above today. Now this Fibonacci level is that of 25.31. What it does is it calculates a high of about 49.82 and a low of 8.46. Now these are significant levels because if we take a look at this on the monthly chart, this is the 8.46 low. So we have let me just put this on for the drawing tool into a paint program. So this is our low in here. We had this high and we had this low. And you can count it as this low, but really when you have a situation where you correct through time and you really break out like we did here, I'll count this as a low in here. Then we had this low here of 26.30, so that's where we made this low at 33. That's why I consider this to be a higher low. But when you make a higher low with this type of penetration, it does make it difficult to make a higher high, but it really, in a normally fairly traded market, it's also not difficult to hold this level and come back, find support, and take it out. Obviously, that was not the case. Therefore, we have this low, we have this high. We have this low, and we have this high. So we've matched this low as of now, but bottoms and tops are known well after the fact, and there's nothing here to state that it can't continue to go down even further. The last previous resistance band area is right here around 20 all the way down to 17, 16 and a half basically. And you can think, well, that's not right. It can't go there because they're creating all of this extra currencies and it's a manipulated market. And like I said, as long as that we still allow the banks to do what they do, they're going to do what they do. That's, to me, is pretty simple. To think that the market's going to change otherwise because of that, well, that's insane, because that's a definition of insanity, expecting different results by doing the same thing, and the bankers doing the same thing is literally the same thing. And now you got this situation here where I think it was Clive Maud talking about a head and shoulders pattern. Whatever you want to call it, I personally don't see that, because I see a different bearish scenario that we're at a level of support that has been tested before. And the more often you test support, the more likely it is that you take it out. Now, moving back to the last situation on the 9-day chart, what's the chances that we come down there and that's the bottom? I can't tell you that, because it still could hold as support because it hasn't literally been touched. It is a major low and it is a major high, so its importance level is really big. But again, because we've already had a touch in here, it could mean failure, then fast move to this little area down towards here. And there's still other significant Fibonacci levels. For if we take a look at this on the quarterly time frame, this is the chart that has 3 months in each candle. So this goes all the way back to the early 90s, which shows the sideways consolidation and a pullback within the uptrend, basically. And the Fibonacci levels we have for support on this one has 1816 and 974. So therefore, if we're going to come back to the first significant Fibonacci level on the more long-term time frame, the 355 low from the 1980s, late 80s or mid 80s, somewhere in there, 87 or I don't know, somewhere in that area, and the highs that we faced a few months ago, then that level is 1816, and it does seem as if it really wants to make a play towards that level, because if we do this on a 76.4 level, it's basically breaking through right now, as that level is, I think, in the closer to 30, with a 32 level, and that 32 level is given in. So most likely it does look as if there's a decent chance that it comes down towards this level, and when goes down towards that level. And when that does happen, that usually means that you can very oftentimes have that quick breakout above it, because you have this situation back in 2008 where it just exploded from the seed after it came down to the $8.50 level. So could the same thing happen again, where it just goes down towards this previous resistance level and then just boom, explodes the same way or in a similar fashion of some degree like it did before? Also to note on this quarter chart, we can see that we're pretty much guaranteed now to have 3 consecutive losing quarters in a row, after we came off of a streak where it was 9, I think. Maybe I'm counting off 1. I see 9 consecutive green candles in here. But looking back in here, there's 3 here. Okay, the last time we lost 4 consecutive quarters in a row would have taken us to the end of the 1990s. So we'll pretty much finish this off very soon. We'll take a look quickly at the half-year chart, as it's changed a little bit as it did before, because what happened was it had 2 similar candles beside each other when this when the market was in the mid $33, $34 range, as it was merely correcting sideways, and it still is, because it's got this floor at 26. It's got a ceiling at a down range. Number 1 is 50. The second one is like 47. Next one would be 44. And you can see the resistance clearly in here. Now, people ask about a cup and handle formation. And And that would be one of my possible predictions. If you want to hear them, I probably will do them anyway, but I'm going to be giving at least 4. One of the 4 is that we do come back down to this 20 level, and either one of 2 things is going to happen. One is something like we've seen in 79 where it just explodes into some degree or another, and another one will be that it continues going sideways and probably breaks down to around $9 an ounce one more time, maybe even 11 and a half, and then over the rest of the 10s, it's just going to have a slow consolidation breakout into the 1920s. It's probably going to break resistance into the 30s, and it's going to take about probably it's going to take about 15 years to get past 50. That will be one. And that's because of how many candles it's going to have to take to develop the right shoulder, then finish its consolidation. It's going to need at least 15, 16 candles. And 16 candles on the half-year chart is 8 years in itself, which would take us to the 1920s. Now, I don't think that's going to happen, but I have to give different possible scenarios, because to me that's the best way to look at all possible situations and then analyze which one is the maybe the clear-cut favorite, or just basically look at all sides to the piece of the puzzle. Alrighty. If you have any questions, please let me know. There's going to be a year-end video. Normally at the end of every month I'll plot on the inflation-adjusted charts, and this year, of course, is going to be no different than that. And what would be, before we go, I'm going to take a look at the yearly close last year. The yearly close was $30.93. That means the market has to go up about $3.50, or that of about 13% or so, just to break even for the year. If we break 2610, then what that means is that we will be at levels not seen last since, let's see, where could we, levels not seen since November of 2010. That would be the last time we were below $26.10 an ounce. And not only that, but if we take a look at this on the half-year chart, in 1979, this is when we first reached the $26.10 variable. Thank you for watching, and have yourself a great day.